Good afternoon, ladies and gentlemen. Thank you so much for paying attention post-lunch here. I'm privileged to have Mr. Ramann as my guest for a fireside chat. As an industry, I must say, we couldn't have asked for a better person to be in charge of the pension capital of all of us, and I'm getting there pretty soon, to direct the capital towards our industry. For many of you who may not be aware, Mr. Ramann has also been a practitioner as an investor in the alternative investment fund industry. So somebody who knows the ins and outs of the industry, and more importantly, has been a friend of the industry, having chaired the standard setting committee of the alternative investment fund industry. So thank you for having this chat. So let me just start for the benefit of others in terms of, since morning there has been a lot of discussion with regard to sources of capital, dependency of foreign capital for the survival or growth of this industry. Putting that in context with regard to the amount of domestic capital that is currently available between pension fund, EPFO, life insurance, for example. I saw a very interesting number. Just one insurance company, life insurance company, if they were to allocate what is currently permitted under regulation to invest in alternative investment funds, that number is 1.3 lakh crores. Similarly, maybe, my first question to you is just for the benefit of everybody, the AUM that you are currently having under the pension scheme, where do you see that going? And then we'll get into allocation questions.
Very good afternoon to all of you. Thank you so much, Srini, for having me here. Thanks to IVCA for once again, putting me up here, putting questions to me which sometimes get difficult to answer, but I'll certainly try and do my best. But when we talk about domestic capital, I think I don't have the numbers probably as well as you do, but the scales are slowly tilting towards domestic capital as compared to maybe foreign capital. And I certainly feel that as we move ahead, as a country, we need to be able to bring more and more institutional capital into this space. Why I say institutional capital instead of focusing on, say, the family offices, there is a certain persistence and a long-termism which the institutional capital brings. And therefore, your point is so relevant. Why is it that we don't have an LIC and an EPFO bringing money into the alternate space? I actually thought LIC was doing a lot of unlisted investments. Till I realized in one of my avatars when I actually ran the information utility, it was an unlisted company, and we approached LIC, an existing shareholder, for a rights issue, and they said, sorry, we've just been we've taken a decision that we will no longer invest in an unlisted company. Now, I thought it was rather strange that you're sitting on so many unlisted companies, but it is something which goes down to a matter of disclosure, trust, the ability for an ecosystem to come up and show that it has the efficiencies and the transparency within it. And I think, that really is a call to all the funds sitting over here. I'm saying it's actually not the role of an IVCA or an industry body, but it's the obligation and responsibility of each fund manager and the GPs who are involved in that can we come up to those standards of governance which are demanded, and this is not demanded just within India, it's across the world. So the moment there is an ecosystem that points out or calls out persons who are probably falling a little short of those governance standards. And that's really where I say an industry body like an IVCA needs to play its role, where you set standards and then you expect that everybody shall conform to those standards.
I think very well said, sir. Coming to the National Pension Fund pool of capital, approximately 16 lakh crores, growing at about 10 to 11% per annum, if I'm not mistaken. I know that, I remember the meeting that we had with you and the pension fund managers when you took charge. And there were a number of challenges that was identified as to why the pension pool of capital in the country is not allocating capital to the alternative industry. Maybe for the benefit of the audience here, if you could highlight that, and I know that over the last 6 or 7 months that you have taken charge, you have really moved rapidly to change that, and you've taken very proactive steps to do that. So if you could just elaborate on that, that would be fantastic.
So the best part is that I didn't take the decision. So it's a very comfortable feeling when you don't take the decision and then you can sort of opine upon it. But the decision was taken actually 4 years ago. And when I came in June of 25, I found that we had not allocated a single rupee towards the AIF part of the alternatives. So within the board decision of 4 years ago, it was up to 5% of the AUM, depending on the choice of the customer. Now, that's really where all the trouble started. So, if one were to understand the industry, it's long term. In fact, my own views are it should be much longer term than the term that we're talking right now. But we cannot allow or cannot conceive of a pension fund committing money when its own pipeline is uncertain. So that's really
the asset liability problem.
Absolutely. I mean, it's a complete mismatch. In fact, it was never designed to be a match. So the whole point is that we have to be able to get a stream of capital which is thick, sticky, and then finally we are saying, okay, there is a commitment that can go into the AIF industry. And that's really what we did. We managed to, didn't take too long or it wasn't too difficult, but it's about aligning your own asset classes. So we had alternatives sitting outside of everything else as a separate asset class. We simply brought in alternatives within the equity or the debt space, such that you have a much larger pool of equity or debt, and from within that pool, you are then allotting X amount of money towards the alternative class. Again, I'm going back to the earlier point I made that why is it that we're so easily putting money into REITs and InvITs? Because the pension funds did not need any prodding to go into those asset classes. So this is really about awareness, knowledge. It abounds over here, but for some reason the pension funds never really found any of you guys coming to them saying, listen, this is what we are, this is what we do. So I think it does require for the regulator to probably step in at that initial stage to set the ball rolling, to one, put the framework together, to create the kind of efficient mechanism. And typically it's going to be a portal. So if people are familiar with the way SIDBs run the entire fund of funds, I mean, obviously that's one of the best examples. I was happy to be a part of it for a while. But it is a great example of how public funds can be made available in a highly transparent manner. And that's really what we've done. We've put it together with the NPS Trust, because the NPS Trust is the body that holds all the money and assets on behalf of the subscribers. So we have now rolled this out. We hope that it should probably get functional fairly soon. And what we're talking about is an AUM of about 17 trillion. And we have earmarked 1% of the AUM for investment into AIFs. And then we've also got the benchmarks ready thanks to CRISIL. So I suspect that, we've got, all the structures in place. It's really about how efficiently we go about the process, because finally, the contribution is going to be made by individual pension funds.
So no, absolutely. I think the steps that you have taken in the short period that it just exemplifies that while decisions get taken, at the end of the day, like all private equity fund managers know, execution is what matters. And I think you've sort of taken that execution step forward. And I'm aware that the portal that he's referring to for all fund managers to essentially apply for the pension funds to participate in there is currently under testing, if I'm not mistaken, the next 24 or 48 hours. A few select players are going to test it out in terms of how it's going to work. So it just exemplifies the execution framework that you have.
I love your inside information.
So, well, somebody told me outside they are testing chal raha hai, so I thought maybe I'll just mention it. But it's fantastic example of how, one can, if there is a will, there is a way. One of the interesting data points that we saw was the average pensioner in India in the NPS scheme is between the age of 18 and 40. So he or she has a long time to go before he or she comes to claim the pension. And when you look at it from the perspective of on the asset side, and you made a remark earlier with regard to longer term, longer tenure products, maybe you can expand on that in the context of the profile of the pensioners.
So yes, I mean, we still have a young population. So the statistic is that today it's about 10.5% of the population that is above 65. This is going to climb to about 21% by 2050. So in comparison to many of the other jurisdictions of the world, even in 2050, we are probably going to look like one of the youngest nations. I think only the African continent is probably better off on that demographic dividend piece. The pension system within India has largely been driven by the government. So, even today, you walk into a room and say, listen, do you have pension? Or you say, listen, I have a pension. It's assumed that you are from the government. Yes. Now, this is really what has to change. And this is what we are changing. So if I were to look at our own growth, the government growth in AUMs are probably in the region of 8 to 11%, depending on how the equity markets perform. But the growth of AUM and more importantly contribution in the non-government sector is somewhere between 24 to 28%.
That's a very high.
It's very high. So it's on a small base. So we are seriously looking at getting the entire PFRDA and the set of intermediaries and the entire ecosystem that we have to go into the market. We've designed a variety of digital platforms, which again are, and luckily you don't know about them, so they're also underway, and we are rolling them out in a couple of weeks. So we have collaborations with NPCI coming in, helping us create some kind of it's a common platform where the banks will be on one side and you have the TPAPs on the other side, the Google Pay and the Phone Pay. So the whole idea is to get the entire, country to be nudged towards what is NPS, do you have a pension account? So the moment you start looking at these, you start getting the awareness of a pension fund. The next question is, what are the returns? And amazingly, the returns of the pension funds have been at par, if not better, than the mutual funds. So, sorry, I mean, many of you are ex-mutual fund guys, but that's the way the dice rolls. And we've seen that the top pension funds, their equity portfolios have returned something like 17 to 19% year on year for over a period of, say, 5 to 10 years. Of course, it matters when you look at those starting and ending points. But I'm just saying that the balance between equity, GSEC, corporates, and now that we've got a bit of gold and silver and the AIFs also kicking in, what we are really keen on as the regulator is these double-digit returns that people have been getting for the last 15 years. If I take the most conservative fund we've got, or the most conservative scheme, it's the government scheme, which is less equity. It was 15% equity. It's now grown to 20%. That has given you 9.5% over the last 15 years, year on year. So, you have to be able to sustain those returns in the next 20 years. And that's really where we're saying, it's up to you guys to give us that return. I mean, that's really what we're asking.
Very interesting point that you made. And, sitting in the IVCA platform for alternative assets, I must give you the data that we as an industry will outperform what the mutual funds have done. CRISIL has just come out with the data, and I think the top quartile performers on private equity have actually provided an alpha over public markets, a significant alpha. That's what the data shows. Similarly, the top quartile of the debt fund managers have also provided a very significant alpha over comparable, CRISIL benchmarks. So I do hope that as and when the industry benefits from the capital allocation from NPS, we will be able to contribute to the pensioners who are saving their hard-earned money with a pension fund. But I'm very glad that the initiative that you're taking is helping the corpus of the pension fund grow faster, because many of the people in this room are looking at that corpus growth to get capital into their own funds. And more importantly, the power of domestic capital and the liability side that young population which enables you to put capital for long periods of time, provides an ecosystem of support, startup companies as well as significant infrastructure companies. So thank you that you're doing this for us. The other question that I had is that when you are looking at fund managers whom your system is likely to churn and select, what would be the key criteria from your perspective, or even the fund strategies, if you have a thought on that as pension fund allocator, you would be most focused on?
We've given that some thought, and I think we've asked the question what we don't want to look like. So, we definitely don't want to look as if we are sectoral. We don't want to look as if we are just startup, we are MSME. Frankly, at the end of it, we're just saying that we are the regular guys here. Any and everybody is welcome to come and show me what is it that you're looking at, what's your investment thesis. We are therefore putting it to the pension fund, saying that it is the return on capital, and that is really a return that we will calculate over 30 or 40 years. So you did ask that question. I don't know whether I answered it squarely, but we would be happy to encourage more and more AIFs to go into what is typically called as a perpetual fund. But even if that is 25, 35 years, I think that's really where we have to start moving towards. It's better for us to keep getting returns for our money to go back into fresh investments, which an AIF may like to make, rather than me getting capital distributed back. Because if I'm finding that there is an AIF which is able to give me returns of 18 to 25%, which I think is great from our point of view, why would I not want to perpetuate that kind of a relationship? So it's really about giving us the confidence that you have the ability to pick up the right companies, you have the diligence, you have the track record, you're willing to work hard at it. And I'm very happy to look at a better match between our liability profile and the assets that we are investing in. And that's really where, that liability profile is, of course, anything. It's money is continuous. So I would be really urging a lot more people in this room to relook at their own strategies. You may certainly come up with funds which are 7 to 10 years, but why not start thinking on the longer profile also?
That's music to our ears. Rajat, please make a note. Take the clip of this and say that perpetual fund is required by the NPS, and please let's talk to SEBI about it. It's something that the industry has been asking for. Thank you for mentioning it here. I see that we have 2 minutes, and you being in this position, I'm sure a number of people would have questions for you. So instead of me asking the questions, I'm going to throw it open to the audience. Anybody has a question for Mr. Ramann, it will be great to have that.
So Vineet told me before I came on stage that he is certainly not going to ask me a question because he wants money from us.
So Vineet, you've got to go with you first. Can somebody give him a mic, please?
I didn't want to say this, but because I have to do the conclusion and some of these points I was going to say there. But anyway, I was in Africa just a week back, 2 weeks back, and one of the things I told the pension funds in Africa, that you are one of the youngest continent in the world, and therefore you have all the opportunity to invest in long-term funds. For you to repeat almost the same thing, saying that 30, 40, 50 years is the way to go, India is still, whether we like it or not, a low-income country going to middle-income country. And if we don't want to fall in the trap of staying middle-income for very long, we require these kind of initiatives. We are all lobbying with SEBI. I think we have capability to set up 30-year funds, but the perpetual funds are not there. Tomorrow, if we list the fund, which again, the capability is there, it may be a great idea. So under your leadership, we have seen what FFS can do, but with you there in PFRDA, I think it's going to be a huge difference. So just a comment, no questions.
Any other questions?
Vivek Pandit from McKinsey. It's good to see you. You're right. You are retirement-oriented, right? And so 2 questions. One is, how do you think about retirement-oriented products that are term-matched, appropriate duration? You talked about permanent capital, but how do you think about retirement-oriented products, which, of course, pension funds around the world have had to construct? Like, fund managers don't come with a retirement-oriented product. You kind of have to construct them. So how do you think about that construction in the context of domestic deployment? And the second is, what are you putting in place to help pension funds who have not been part of a selection process earlier to get smarter about who to select and what they're going to use to determine an appropriate level of liquidity requirement, risk requirement? How do you think about that today?
So the retirement fund landscape within the country is, as you would probably all know, reasonably fragmented. There is an attempt at the ministry level to try and create some sort of harmonious regulations around the different kinds of funds that exist. But more crucially, and we are talking about retirement funds being held for 30 to 40 years, which typically pertains to the accumulation or the gathering phase, as in all our lives we would do. But we also need to look at another 30 years, because all of us are going to live to 90. I certainly wish it upon everybody. But the point is that there's a lot of money in this country which is probably not finding the right place. And therefore, we are really looking at pension funds holding money for much longer periods of time. So we've already taken the age for the NPS all the way up to 85. Now, there are different profiles of people. Therefore, you have profiles where people probably don't need that much money and they're happy to keep it invested. So we're looking at even longer periods of time of money that is invested. We're also looking at pension funds making payouts towards pension. Now, till now, it's only been the annuities offered by life insurance companies which are serving as a pension. Now, they are not inflation indexed. So we've come up with some models which is out there in the public domain where we're looking at how we can create inflation indexed baskets where people are drawing down 3 to 4% a year or depending on their own needs. And therefore, we're looking at pools of capital remaining with pension funds for sizably long periods. So that really is something which, over a period of time, we're going to probably fall, short of assets. I mean, how are we hunting for the next set of assets where we can also park some amount of money? The debates are going on forever, whether we should go into small caps and micro caps. But I'm saying there's a much vaster, more vast, sort of set of assets that we need to also look at. And that's really where I think we've got another committee which is already up with experts from, various fields, which is looking at what are the, sort of diversified sets of assets that we could look at. But the pension funds per se, I think we really need to get a lot more capacity building within them, because there is going to be a huge need for them to be able to appreciate better the risk return rewards of various asset classes. So I think there's going to be a lot more just knowledge sharing, if nothing else.
We're running out of time. Thank you so much for coming here and giving us your plans going forward and all the stuff that you're doing to create that Atmanirbhar capital pool for all of us to potentially put to work and pay back our own selves, because our money is also with you. And I'm sure you will make it pension fund bhi sahi hai. Thank you so much.